Alright guys, welcome back. I hope you're all well. So this week in front of us we have the economic calendar. Just going to quickly run through this and answer a question that I had from a student regarding expectations. And then we'll do a bit of analysis, what transpired from last week, and then I'm going to show you a good example of how we can incorporate power of 3 as a filter for entry criteria. So firstly, as you can see here, on Monday, we aren't expecting any high impact news. So generally, I wouldn't trade on a Monday unless it's non-farm payroll week. And I'll show you what that looks like in an example later on in this presentation. We've got some heavy hitters here on Wednesday, CPI and FOMC. So again, you want to be very careful trading on Wednesday. On Thursday, we have PPI and unemployment claims. And then Friday, 10 a.m., we have consumer sentiment down here. If you are trading, I would let CPI and FOMC settle before going in. Thursday, Friday will probably be decent trading days. Monday, I would avoid here with no news and it not being a non-farm payroll Monday. Tuesday would be a safe day to trade as well. I want to spend as little time as I can on these charts, and the economic calendar helps with that. It gives me the day and the time where there's going to be an injection of volatility. So I use these times and these days of the week to position myself in front of what session I want to trade that day. I revolve my week around the days of week that I'm going to be trading, and it's not every single day that I trade. And that was a learning curve for me because I assumed day trading was trading every day. And when I first started doing this, I would be taking 5-10 trades a day sometimes. And this is something that neophyte traders get caught up in, is the more you trade, the more money you're going to make. And it doesn't actually work that way. It's the opposite. The more you trade, the more money you're risking to lose. When I stopped viewing day trading as everyday trading, and I started to hunt for the best setups, the best quality setups that I could find, and I revolved my trading times around the economic calendar, I realized that the less I traded, the more money I made. And that is going to come by way of experience, where you can identify high quality versus low quality setups. Now, I would rather take less trades, and when I see the best quality setups, I increase my risk on those trades. At the moment, I'm trading maybe once or twice a week, and sometimes there goes a whole week where I don't even trade. My favorite time window is the New York session, and generally I'm in front of my charts 2-3 times a week during the New York session. Now, I got this question regarding news drivers, and it's a great question. The question was, is news always going to be manipulation? Is it always going to be a Judas? The answer is no, right? And funnily enough, in today's example, later on in this presentation, I will show you an example of why it isn't always just manipulation. In some cases, manipulation could have already taken place before the news event, and then the news event is that injection volatility and price continues rather than reverses. But again, I will show you an example later on in this lecture. Again, I cannot stress how important the economic calendar is. You have to get comfortable and familiar with the economic calendar, and I put this off for years. But this helps you frame your trades. It gives you the schedule and the template for the week. If you want to do this professionally and you want to take this job seriously, then you're going to have to incorporate stuff like this into your analysis and into your trade routine, right? CPI is usually a one-sided event where price just really takes off. And FOMC is generally a two-stage event where it will sweep one side liquidity and then reverse and then run for the opposite liquidity. I never ever trade CPI. Well, I used to, and I got my ass handed to me, so I've learned my lessons not to trade CPI. I do tend to trade FOMC if everything aligns. And again, what I'm looking for with FOMC is a two-stage event. If I have strong conviction that the market is likely to go lower, and then I see FOMC rip higher, running buy-side liquidity, and it comes into a higher time frame PD array or a higher time frame DRT level, I'm selling that. It's taken a lot of years of experience to understand how to trade FOMC, right? And that brings me on to the question that I got asked about expectations and how long this should take. In my honest opinion, if you were to take, say, any indicator-based strategy and you were to apply money management and risk management, you can make any strategy out there work. The difference is you're playing a numbers game versus precision and understanding. And it was something that I encountered in my own journey when I was studying ICT concepts. And I'm sure you can probably relate that there's probably been one point of your journey, especially in the beginning with ICT, where you thought to yourself, is this worth it? Right? Because there's a whole lot of information. And I went through this same dilemma where I was like, I can see that these concepts work. I can see the precision, but it seems like it's a mountain to climb versus doing something like an indicator-based system, right? Fast forward to where I am now, I am super, super grateful that I stuck with ICT. Yes, it's taken me longer. How long do I think it takes to actually start making money and become profitable in trading? In my opinion, around 4 years. I would say that it takes you maybe a year to 2 years to pick up the skill set of understanding how to read price effectively. I think after 2 years, I was very efficient with reading price. The problem is because there's so much information, especially with ICT, most of that time for your first 2 years is just spent studying. You're not really getting much chart time or experience. And it's the chart time and experience that makes you profitable. Of course, the studying is important and the journaling and the backtesting is all important. But the chart time and getting actual real trade experience, I think that's going to take you 2 or 3 years of getting the experience and understanding yourself in these charts. And that's the same with any indicator-based system or any strategy that you're going to use. You can learn the strategy fairly quickly, right? But understanding yourself and gaining the experience, that is still going to require years worth of understanding, trading, getting actual chart time and still journaling. The reason I say this is because there's a lot of people who come into the industry because they have seen people on social media and they make it look like it's easy. They're not telling you the truth about how difficult this industry is and how long it's going to take. You see all the adverts everywhere of saying, use our system and you get an 80% win rate and you become profitable in 90 days and blah, blah, blah. It's all marketing. If people are on social media and they're flexing their lifestyle, stay away from them, right? There's a reason why I do not flex anything. I don't show anything because what I have done and what I have made and the success that I have got is going to do absolutely nothing for you. But what I can do is help you understand price action. I can help you understand ICT by providing you with value, which is why across all my socials, I only provide value. Sometimes on Twitter, I might talk shit, but to be honest, I'm not really using that platform anymore. I just don't like it. It's X now, isn't it, right? Now, the reason I'm telling you this is because, number one, I want to be honest with you. And I want you to get into the right frame of mind early on in your journey that you're looking at 3 to 4 years. Anything that you do in life is going to require work. Try not to put a time limit on how long it's going to take you because, yes, it's different for everybody. Some people do it sooner. And I know some amazing traders that has taken even longer, like 6, 7, 8, 9 years. They just didn't give up. That was the difference. That is the difference in anything. It's why did somebody become successful is because they didn't give up. They got their ass kicked in these markets just the same way as you did, but you gave up and he didn't. Do you understand? Often when people ask me how long does this take is because they need rewiring because they're already trying to rush the process. And over the years, I've seen students come to me with the same exact thing. When will I start making money or how long is this going to take? And 90% of the students who ask me that question quit within the first year. So I hope that answered your question and I hope somebody else took something away from that. Anyway, let's get into the charts. So price action hasn't been great, right? And again, we are in a longer term consolidation. And that makes the lower time frames much more difficult. I explained this in last week's lecture. Now, why is price difficult? Why is price choppy? Well, if you followed me for a while, and especially my private students will know that I always refer to the yields, right? So I'm looking across at the bond market because the interest rates move everything, right? And specifically, I'm looking at the yields, which is inversely correlated to the bonds. Now, in front of you, I have the 10-year yield price. And I just want to go through this chart and explain the reasons of why we're seeing asymmetrical markets and choppy markets right now. So here we have our DRT levels. Already you can see how we're staying between the 75 DRT and the 50 DRT. So we're in the upper half inside of a premium relative to the dealing range high and the dealing range low down here. Currently, we are consolidating inside of this buy-side imbalance, which sits around equilibrium of our dealing range. Now, this is on a weekly time frame, and if you notice the bodies of the candles being contained inside of this buy-side imbalance, and we're just having wiki back and forth price action, just running stops on both sides. This is really seek and destroy. And again, my students know, and I've been saying this for a long time, that seek and destroy profiles are likely to occur at equilibrium. And they are notoriously difficult conditions and environments to trade in. If we are in a consolidation on the yields, then we're likely to see consolidated prices on the dollar index, right? Because the dollar follows yields. And this is why I look at the yields, because it's easier to draw the correlation between dollar index because they both move in the same direction. Whereas the dollar index is inversely correlated to the actual underlying bonds price. We've swept buy-side liquidity above this high and tapped into the upper quadrant, which is our extreme premium. And we've rejected from the consequent encroachment of this sell-side imbalance. We've also completely rebalanced this buy-side imbalance down here. This is very, very difficult to trade. And from where we are, price can go in any direction. If I can make a case of both sides of the market, then I sit on my hands and wait for more information. This is one of the best pieces of advice that I ever had from ICT. I would favor higher prices from here. But when I look at the triad, so the 5-year, 10-year and the 30-year, I'm not seeing any cracking correlation that I would like to see that would give me more of a directional bias, right? So this is why when we are in this kind of consolidation or a seek and destroy profile, you're going to get markets that move out of sync. If you look at the euro and the pound, for example, right? Anyway, moving on, we have the dollar index here on the daily time frame. Now, we've been consolidating inside of this buy-side imbalance. And again, price here is very difficult to read. I've already identified the major buy-side liquidity above these relative equal highs and these relative equal highs here, as well as this liquidity void. Ideally, I would have liked to see price run lower to upset the trend line. And generally, when I see a trend line, I like it to touch the midpoint, which would be down here. And below this, we have this low and this buy-side imbalance over here as well. Obviously, it doesn't need to get down there. And what I expect in the market doesn't care about that, right? Obviously. So if my expectations don't pan out, then I have to sit on my hands and wait. Let me zoom into this piece of price action here, and we can see this in a bit more detail. Before I forget, I did these slides this morning, right? So this is Monday's trading. Now, usually I make my slides on the weekend before the market opens on Monday. But this weekend I was too busy to actually create the slides. So I've created the slides this morning and I'm currently sat down recording. You can see here that we are again here in a seek and destroy where we're just running highs and lows. I am interested in this volume imbalance here inside of this order block. And I want to see if we can reject this area. We're currently rejecting it as I'm speaking. And I am noting the equal lows left down here. In this piece of price action, we have major buy-side liquidity above the relative equal highs, and we have the major sell-side liquidity below this swing low. Now again, I feel that there's a lot of sell-side liquidity down here, and I would rather see the dollar move lower to upset that trend line before continuing higher, because then we've unseated all the buyers And I would expect smart money to pair that liquidity to then run for the sellers and the buy stops above the relative equal highs, right? But until I can see something more convincing in price, this kind of climate is going to be more suited towards intraday scalping. Now, I do like how we have run into an extreme discount relative to this dealing range from this high to this low, and we've swept sell side liquidity below this swing low and then run higher and closed above this swing high. We do have buy-side liquidity above this swing high, which sits below an extreme premium. So again, we could just knock about inside of this range, and it could be held in this consolidation for a while inside of this range. We don't know. And again, this is what makes Forex very challenging at the minute. If I contrast what we can see on the dollar index with the euro dollar, the first thing that I notice is on the 9th of April, we have this high and we have the equivalent low here on the dollar index. So the range from this low to this high is the equivalent range on the euro from this high down to this low. Now you can clearly see that we've already run the major buy side on the euro dollar, but we failed to run that major sell side below that dealing range low on the dollar index, right? So this is already suggesting that the dollar has strength behind it and doesn't want to go lower. We can also see how we gapped below this swing low here and closed below this sell side imbalance, leaving this liquidity void, right? So this is an actual gap. I can't see any further imbalances inside of this dealing range. We do have this swing low, then obviously the major sell side if we want to continue lower. If that were to happen, I would want to see euro potentially run higher to fill this gap, reject from the consequent encroachment of this buy side imbalance, and we also have these consecutive up close candles which would act like a bearish order block. I'd want to see some form of displacement through here to give me conviction that we're likely to run the lows down here, and that would mean that the dollar index will draw towards the relative equal highs and that liquidity void to the left. If we look at last week's price action on the dollar index, here we're on the hourly time frame, and we have Monday through to Friday delineated with these blue vertical lines. Now already you can see where most of the price action was contained, and this is again typical for non-farm payroll week, where we're going to see consolidation early on in the week. These DRT levels are the same DRT levels from the 4-hour time frame that I spoke about in last week's lecture. And we've consolidated in an extreme discount relative to that dealing range, right? So between 0 and 25. Monday would be a trading day, considering it's non-farm payroll on Friday, right? So that's the rules that I use when trading Monday's price action. What transpired here on Monday? Number one, you can see how we ran above this swing high, sweeping that buy side liquidity and tagging the equilibrium midpoint of the dealing range. We also rebalanced this sell side imbalance that sat above the buy side liquidity. So what is the algorithm doing here? It's killing two birds with one stone, right? This becomes a very strong draw on liquidity. This up close candle that rebalanced this sell side imbalance and sweeping above this swing high is the order block. When we run through the opening price of this up close candle, this is our change in state of delivery, where we went from a buy program into a sell program. The up candle that rebalances is important. It becomes a high probability order block. So there's two things that classify as a high probability order block. There are others, but the two main things are the candle that sweeps liquidity or the candle that rebalances. Again, because they are the two primary functions of how IPTA moves, right? Reprice to inefficiency and reprice to liquidity, right? Again, notice how we ran into the 50% DRT level. You can see how the bodies of the candles here have failed to close meaningfully above that sell side imbalance, and also they've closed below that 50% DRT level, and you can see how we tap that here and then roll over. If we take the swing low to the swing high, which was our initial buy program, and we project 2 standard deviations lower, we get a level of 103.993. If we extend that out and we take the exact low of this candle, comes in at 103.993. Highs and lows are mathematically derived based on buy and sell programs and swing points. Buying and selling pressure is not what is moving the markets. The markets are moved based on a mathematical formula, right? We multiply this range by 2 going lower, which actually gives us our low of the week. Price is contained inside of this range from this high down to this low for the remainder of the week. And then on Friday, we have non-farm payroll, and price really takes off. You can see how we gapped open on Sunday. What are retail looking at here? This is a head and shoulders pattern. So they're waiting and anticipating the break below the neckline, and obviously smart money had different ideas. Notice how we have really small ranges and small candles prior to the large range. They're holding the market here in a small tight range prior to non-farm payroll to engineer buy-side liquidity above these highs, and these highs up here. And then they run Monday's high on Friday. So anybody who was short from Monday, their stops have now been smashed. Let's take a closer look at Monday, and we'll go onto a 15-minute time frame to see this in a little bit more detail. Here we have a nice example of the power of 3. Now, there are a lot of caveats to the power of 3, and I'm going to go into more detail about the power of 3 during the summer bootcamp. But why power of 3 is so effective is because it gives us a filter, right? That filter is the opening price at 12 a.m. midnight New York Eastern Standard Time. Now, if we are going short, we want to sell above the opening price, and if we are going long, we want to sell below the opening price. Now, let me add the London session and the New York session. Firstly, you can see how price was consolidating and staying inside of this range, building a pool of sell-side liquidity below these lows. What sat below these lows? This buy-side imbalance. Again, the market will move to kill 2 birds with 1 stone. In London, we drop, creating a swing low that swept the sell-side liquidity below these lows and rebalanced this buy-side imbalance here. Price then runs higher, closing above this high. We then create this down close candle right in the heart of the London session, which runs into what? These 2 consecutive down close candles here and the opening price at 12 a.m. Price then displaces higher, leaving this fair value gap and running above the relative equal highs up here. We find support inside of this gap and then make a run higher, just coming shy of that equilibrium level from the higher time frame. If we take this swing low and this swing high and we project deviations higher, between 1.5 and 1 deviation we get 1.25, which is in close proximity to that equilibrium level, and it comes in at 104.767. The actual high of this candle comes in at 104.767. Now, what are we seeing as we're making this high if we bring it into market analysis? Well, as we were creating these higher highs, if we look at the British pound, at the same time as the dollar index creating these higher highs, we're failing to go lower on the British pound. In fact, the British pound is creating higher lows here, right? And since these are inversely correlated, we would expect the pound to make lower lows as the dollar's making higher highs. Now, this is a cracking correlation. This is a valid SMT where price has come to a higher time frame key level. We then see price reverse, and at the beginning of New York at 7 a.m. you can see how we formed this sell side imbalance. We can see price run higher and touches it here, digging into that sell side imbalance, but the body's closing below it. Again, this suggests weakness. Not only that, we also have this down close candle inside of a previous session which overlaps with this sell side imbalance. You can see the consequent encroachment of this distribution block. We nail it there really nicely before displacing lower and closing back below this swing low. Now that we've closed back below this swing low, we do not anticipate price to run higher back above this high and into this sell side imbalance because this becomes a breakaway gap. you can see how we've left another sell side imbalance here. Price runs higher, nails a consequent encroachment, closes back below this swing low, leaving another sell side imbalance. Now this sell side imbalance, if we extend to the left, you can see this acts as a balanced price range. We have sell side delivery here, buy side delivery here, sell side delivery back through it, and then we act as a brick wall. So we've repriced lower, we've redelivered higher, we've rebalanced back through that range, and our price is balanced. Now this candle running above this swing high into that sell side imbalance and into the balanced price range occurs just before the 10 a.m. manufacturing PMI. Now this goes back to the question where do all news events cause manipulation? In this case, you can see that this is a market maker sell model, right? The manipulation occurred earlier on in the day and we had our turning point over here that was further confirmed with the SMT divergence. Now this swing low hasn't been swept yet. We're still inside of the range from this low to this high. The manipulation occurred earlier on in the day running the equal highs to the left over here. We then had our change in state of delivery and price ran lower prior to the ISM manufacturing PMI. So we're already in close proximity to this swing low down here. We've already seen price run buy side liquidity, and then the candle prior to the numbers being released, we run into our sell side imbalance and our balanced price range. So when the ISM manufacturing numbers hit, price really takes a nosedive and acts as a continuation of the existing sell program that started up here, right? Notice where this swing low comes in, right in the heart of the London close, which is from 10 a.m. till 12 p.m. Yes, price does drift after this, but I am not interested in anything that occurs in terms of price action after London close. Now, the best setup will occur in the upper 50% inside of a premium relative to this dealing range low and this dealing range high. Notice when we came into that distribution block and into the sell side imbalance, we had also dipped into a premium and was in close proximity to the opening price. Now, this would have been the best entry. If I were to trade this, this would have been the ideal entry. My stop would have been above this candle's high, because we also have another small sell side imbalance here. But above this candle's high would have been a good stop because we're also sat above that 75 DRT level. The bulk of my position, if I'm being honest, would have come off here. I would have taken another partial here, and then I would have left a runner to see if we could get the low form in London close, right? Generally, we're forming the high of the day around London and the low of the day around London close in a typical sell day using the power of 3. So I think that will be all for today. This may come out a little bit later since I've only just done the slides. I still have to edit this once I finish recording. Generally, I'm aiming for Monday 9 p.m. UK time to release the mentorship lectures. I've had a few people asking me about that. But this one might be a bit later, so I do apologize. But anyway, I do hope you found this one insightful, and I will hopefully catch you again in next week's lesson. Take care, guys.